Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm glad to have with me once again Michael Oliver, and would just ask all of you out there to jot down his website. It's olivermsa.com, Oliver, M as in Mary, S as in Sam, A as in Albert.com. Go there for additional information on this great technician's work. Topics we speak about with Michael, mostly debt, equity, and precious metals markets in general on this show, but Michael covers many more things than that. Within the equity markets, he covers some major stocks like Apple. He covers major foreign debt markets like the German bunds as well as U.S. Treasuries. He covers a host of commodities like cattle and oil and copper. He covers biotechs, muni bonds. He mentions all kinds of spreads that are very helpful in finding directions and relative values of various markets, and foreign stock markets and currencies as well. In short, Michael's service covers many more markets than he discusses here. We're focused mostly on gold and the equity markets and the bond markets because those are the biggies as far as we're concerned. But Michael really does provide a great service for his subscribers, and I would suggest if you're an accredited investor, you may want to consider subscribing to his letter. It's olivermsa.com. Welcome, Michael. Thanks for joining me again.
I'm glad to be back, Jay.
Always good to have you. Today, the markets have been in considerable turmoil, it seemed earlier. The equity markets were down more than 200 points in the U.S., the Dow was, that is. And the S&P and the NASDAQ were down hard as well. Gold got tanked really hard, and that's what I'd like to ask you about to start with. Gold hit a low of 1140 in March of this year, I believe, and today, as is so often the case, in the London PM fix, it was smashed down hard, this time falling about 1148, at least that's what I saw on my screen, or very near that 1140 mark. Now, today a fairly well-known technician named Clive Mond put out an article on his gold price charts that suggested that gold was likely now heading towards a very major support of 1,000. And, you know, Michael, as I looked at the charts, strictly from a price basis, some time ago I thought, gee, get prepared because that looks like that could be the real strong base at 1,000. But, you know, you, as you've expressed so often on this show, you look at things other than just price. What are you seeing as you look at your momentum and structure? What are you seeing for gold now? How worried are you that we might see 1,000?
I'm a bullish fence sitter. I mean, I think if one is an investor and even a trader in gold, I mean, and your outlook is several quarters, being long gold around 1180, which was the low in the summer of 2013 and again late 2013, that was plunged out in a spike, which I know a lot of people are looking for another one, but that occurred in November of last year. We spiked down to a low of 1131. Meaning the low 10-point tick was 1140, but almost got to 1130, then soared back up above the 1180 level, the prior broken lows, as if, well, I broke it, but so what? And since then, the market has been in an arm wrestling match. And I'm gonna suggest something to frustrated gold bulls and those who are looking for this big spike to 1,000. Let's say you're long S&P 7, 8, 9 months ago, and you got to be frustrated as heck right now because you were down on the year today. We closed last year at 2059. We're up on the year now by 10 points or so. But the point is that here it's been this many months gone by in the great bowl of S&P, and you're kissing your sister, as it were. Okay. The same is true with the gold bears or the awaiting gold bulls who want that opportunity at 1,000 or wherever they think it's going to be. They've got to be getting frustrated too because we've taken a lot of these downside stabs in the last 6, 7, 8 months, and they don't seem to get traction. I'm of the opinion that new low, if it's going to occur below the 1131 low of last November, will probably only carry to 1080, not to 1,000, but 1,080 to 1,090 area. I've got some reasons for that. If we make another spike low, and I'm not even sure we're going to do that. Meanwhile, if I were a short in the gold market right now, looking for that next 100-point drop, if I saw the market go back above the high of this week, which was 1174, or if I were short gold miners and I saw the GDX go back above the high traded this week, or the HUI go back above the high traded this week, and go to your screen and find what that number is, I'd cover because something's wrong. You're not getting your downside. Now, I'm not going to forecast that we're not going to get that sharp break or that we're going to recover from right here, but I'm saying the bears in gold got to be about as frustrated as the bulls. And I think that's a context to think about.
Yeah. Well, so certainly the gold share investors also have gotten really, really stressed out because of, we've been sitting here since 2011, and it's very painful. I can tell you, as being someone who's probably long more than I should be on the gold market, in the gold share market. And yet, Michael, as a fundamental analyst, I look at companies and I see, unless you think gold is going to $100. There are some just absolute bargains out there. Well, let's say $1,000 might get me concerned. But you had earlier thought that when gold finally turns around, the gold shares should outperform the bullion. Are you still of that mind?
I'm still of that opinion. I think that they'll both turn at once. Right now, the gold stocks remain weaker than gold. Most of them have made new lows versus recent year or so lows in the various metrics, the XAU index, the HUI, and so forth. Marginal new lows. No momentum reading that I've got is confirming those lows. So that's a bullish positive. So if you make a new price low, but momentum says, no, I'm not making a new low, that type of divergence is a tap on the shoulder. It says, hey, this thing's running out of gas. Despite the overt price scariness, it is running out of gas, it is old, it is basing. And my opinion is that when you get your first turn from gold, whether it's from 1,000 or whatever, or from right in here, that the percent gain in that first surge in gold will be far less than the percent gain in these gold miners. They're bottle rockets. They could go up 50, 70% in a heartbeat from current price levels, whereas gold, this can be hard for it to do that. So I still think, yes, watch gold as your core, your metric that you're measuring, but go with the gold miners once you can identify a turn in gold.
Well, it makes certain amount of sense from a fundamental point of view, especially if you've got a gold company that's their project is break even at current gold prices, and as soon as you start seeing something on the upside, all of a sudden they start making money. So that's from a fundamental point of view. But I'd like to ask you about the S&P gold spread. What does that tell you? What are you looking at there, Michael? Because I know you're big on spreads, not only in the S&P, not only equities to gold, but a lot of other spreads. But what are you looking at there? The relative value?
What a spread is, for your listeners who may not know, is simply measuring one asset versus the other. Instead of gold versus the number of dollars per ounce to buy gold, it's how many ounces of gold to buy the S&P. So you divide the price of gold into the S&P and express the difference as a percent. You plot it. Go back 10, 20 years, whatever. Right now, gold is 2 to 3 times higher relative to the S&P than it was in 2000. So if in 2000 you went long gold to short the S&P, you're making good money. So as an asset category, gold is handily beating the S&P over the last 15 years, and you can go back further. Now, recently it's lost because from 2011 that spread collapsed, but it's still much higher than it was in 2000. The action of the spread, difference between gold and the S&P over the last year, has stabilized after gold lost a lot of its relative value. And it's stabilized in such a way that when I look at the momentum charts of the spread, it says this is a bottoming pattern. Now, I don't have a breakout yet where gold is asserting its power over the S&P once again, but we're not far away. It wouldn't take 30-point S&P drop and a $30 rally of gold to pretty much lock that in. So right now it's fence sitting, just like the gold market is. On a net price basis, it's fence sitting. People are tortured both ways. The spread, though, has a biased look to me of a bottom, indicating that gold is preparing to again assert itself into a positive trend versus the S&P.
Okay, Michael, with about 2 minutes left, you indicated before we came on the air that you're really watching very carefully. You think this is a key market, is the German Bund, I believe, and the Treasury markets?
Well, yeah, I expected when we first got a sell-off in the equities, European and U.S., that you would get it buying flight to safety into U.S. T-notes, T-bonds, and the German Bund, which are the more stable of the debt instruments. But as the ECB priced the yields down to unrealistic levels in the French, Spanish, Italian, and German Bund, to zero interest rate or trivial interest rate levels that are off the page ridiculous. That came undone in May and June of this year when we had a rapid rise in yields in the European bond markets. But what's happened in the last week is even more interesting. It indicates not only have market forces taken over the interest rate pricing in Europe, but they've differentiated now between the German Bund and those three others, the French, Italian, and Spanish. The German Bund in recent days, the yield has dropped back down as people have bought into the Bund for safety. But the yield in the Italian, French, and Spanish bonds has barely come off the highs.
Wow.
So there is a movement into the Bund, but not into the French, Italian, and Spanish bonds. That, I think, is what the Greek issue is about. It's not Greece itself. It's pointing out bad debt. And if three countries have bad debt, have much larger proportions than Greece, those are the three. And the spreads of those markets is indicating to me that investors aren't flocking back into those bonds. That's a spread difference. That's an important spread difference.
A very, very important difference. Yeah, we saw it before also. When the spreads widen like that, it's indicative of major problems as a flight to quality. Last year we saw Cyprus, the problem with Cyprus. This year Greece is much, much larger than Cyprus. And this thing just keeps building as they try to defy the natural laws of economics, I think, Michael. And, we depend on you to help us see the structure and the momentum and that sort of thing. So, again, thank you very much, Michael, for being with us. It's always a pleasure to have you on. I always enjoy your insights because I think they're very solid in terms of what you're looking at, the foundational supports that you're looking at. A different approach than most people take. So thank you very much for being with us. And
always enjoy being on. Thank you, Jay.